Hello. Alright, so welcome to this episode of the Stocking Profit podcast. Today we're going to be talking about risk management. Okay, how do you improve risk management in Forex trading? Without further ado, let's get into it. So it is true that Forex trading is a thrilling adventure, right? It offers high potential rewards, but also is fraught with a lot of risk. And this is what everyone who comes into trading, must know and understand. Now, without a solid risk management strategy, the exhilaration of trading can quickly turn into financial turmoil. However, by adopting some effective risk management techniques, you can safeguard your capital and also increase your chances of success in the world of currency trading, in addition to, of course, safeguarding your emotions, your psychological state. Now, in fact, risk management is the lifeline that keeps you in the game of trading for the long haul. Today in this podcast, we'll try to explore some of the key steps that would help you improve your risk management overall. Now, the first thing I want to talk about is education, right? Educate yourself. Now, when I say education, I'm not just talking about education, in the general sense, education of maybe Forex or trading. I'm talking about education about, risk itself. You need to be able to understand what that even means when we talk about risk management, right? Now, it is said, some people say education, or rather some people say, if education is expensive, try ignorance. And that's the reality of a lot of people. A lot of newbies who come into trading, they don't even know what is risk management. They don't even know how much you're risking per trade. They have no idea what you're doing, right? And it becomes expensive because they've chosen not to get the right education. As a result of that, they pay, through their mistakes in the market. Now, one of the first and most important steps in improving your risk management in Forex trading is to educate yourself properly about risk. Now, what that means is that you need to gain a deep understanding of the Forex market, its dynamics, and the factors that influence currency prices. Now, you have to familiarize yourself with trading strategies, technical and fundamental analysis, and various, order types, whether it's a sell stop, buy limit, sell limit, all the instant and pending orders. You need to understand what that means, right? So the more you know, the better equipped you'll be able to make informed decisions and manage risk effectively. Okay, now the second thing you need to understand is you have to set realistic goals. Now, this is super important, right? Because many come into trading with false expectations due to the social media posts from so-called trading influencers, not realizing that while some of these guys are actual traders, most are just selling something else, maybe selling courses or whatever, right? So you need to be able to understand what your goals are, and you have to define clear and realistic trading goals. You need to be able to determine your risk tolerance, okay, and how much capital you're willing to commit to Forex trading. Now, you also have to set specific objectives for your trading, such as your monthly or your yearly, profit targets. And this can help you, stay focused and disciplined in your risk management efforts. Because if you don't have realistic goals in place, what happens is that you begin to chase what you see others doing. If somebody online is saying, I'm doing this, you also begin to do this. They say you're making 10%, you begin to chase 10%. If they say they're making 20%, you begin to chase 20%. Without having a clear, realistic goal for your trading, you'll just be all over the place. Now, the third thing you need to do is use stop loss orders. Use stop loss. There's a reason why it is there. Stop loss simply means that your analysis is wrong and then you should be stopped out at this particular price point. You have to learn how to use stop loss orders. There are people who say they don't use it. I don't recommend it if you're just starting, and anything can happen depending on what you're trading. Fundamental news can really just make the market to go haywire. You just have to learn how to use stop orders in all of your trades. I don't care, how you trade. It's really, really important. Okay. Now, always use stop loss orders. They are your best friend when it comes to risk management. These orders allow you to set a predetermined point at which your trade will automatically exit if the market moves against you. Now, by using stop loss orders, stop loss orders, you establish a limit on your potential losses, so preventing you from letting losing trades spiral out of control. If you're someone who has maybe been in the trading industry for a while, you probably would have seen videos of people who entered trades and they were just hoping that the market was going to reverse. They were just hoping and hoping and hoping and hoping, and not like they had mental stop losses. They were just hoping and hoping and hoping until they lost a lot of money. And that's something that can happen if you don't use stop loss orders, because you begin to allow your emotions to fly all over the place, and you need to have a check on your emotion. Trading is not about making all of the money in one single trade. Trading is a process, and you need to be able to embrace that process more than just the short-term gain of just recklessness in terms of how you expose yourself to the market. Enough said. Now, the fourth thing you need to pay attention to, or you need to learn or know about, is calculate your position size. You need to be able to do that properly. Now, you need to learn how to carefully calculate your position size for each trade based on your risk tolerance and the distance to your stop loss level. Generally, it is advisable to risk no more than 1 to 2%, depending on your knowledge and experience in the market. Right? This can of course go higher, 5%, 10%, depending on your skill set. Now, in the Stock and Profit mentorship, right, which I created, I share a tool that helps you to do this in seconds. In other words, you don't have to calculate, okay, how much I need to from your account. You don't have to start doing the manual calculation or computation of, okay, how much am I going to risk, what percent am I going to risk. The tool is just there on your MT4, MT5. You just put in, your balance, your account balance is there. You just choose what percentage you want to risk, and then calculates it for you, and then you're good to go. So I shared in the Stock and Profit mentorship. You can check that out. So understanding how to calculate your position size just ensures that you're not putting too much of your capital at risk in any given trade. Now, the only thing that is certain in trading is that you're going to lose. So if you know you're going to lose, then you should be able to anticipate, or you should be able to know how much you're going to lose if you were to take a trade. And that should be basic, right? Now, you also need to be able to maintain a favorable risk to reward ratio. Now, another important cheat code is the risk to reward ratio. In my opinion, it is one of the most critical elements of risk management. The risk to reward ratio represents the potential reward in relation to the risk you're taking in a trade. Now, you need to be able to aim for a risk to reward ratio of at least 1 to 3, where the potential reward is at least 3 times the amount you're risking. A favorable risk to reward ratio can help ensure that your winning trades can compensate for your losses, resulting in a profitable trading strategy over time. And then the sixth thing is keep your emotions in check. Okay, now emotional discipline is crucial in risk management. Fear and greed can lead to impulsive decisions that undermine your trading strategy. Now, stick to your trading plan and remain disciplined even when faced with market volatility. Okay, emotional control is the foundation of effective risk management. Now, in this podcast, in some other podcasts rather, I've emphasized, the underrated place of psychology in getting you from struggling, to success. And your emotions, it's something you just have to keep in check. And if, for example, I've talked about, stop loss orders, if you don't, put stops in place when you're trying to take trades, what you're just going to be doing is you're just going to be playing with your emotions, and that's going to affect your psychology a lot, especially when it happens that the trade doesn't go in your own direction, right? And you begin to take losses upon losses. If you're not careful, you're going to really, really, really mess with yourself. And then lastly, you have to review and adjust. Now, regularly reviewing your trading strategy and risk management practices is one of the keys, to ensuring that you're actually developing and growing, and developing a solid risk management plan. Now, you need to be able to learn from both your winning and your losing trades, and you have to be open to making necessary adjustments as the market conditions evolve. Your approach also need to adapt as well. You have a strategy that is true, but if the market is changing, then you have to be able to adapt. Okay, and yeah, that's what it is. Lastly, now, you have to be able to utilize risk management tools. Okay, I've mentioned in the stocking profit course, I share the risk management tool that you can use, and many brokers also offer risk management tools. Some of them, of course, at the basic level, they have your stop loss orders, limit orders, trailing stop, features. You have to take advantage of all of these tools just to ensure that your risk management strategy is actually catered for in your trades, right? So, in conclusion, now, there is no doubt that risk management is an integral part of successful Forex trading. By implementing these strategies that I've mentioned, about 10 of them, and continuously improving your risk management skills, you can minimize potential losses and increase the likelihood of achieving your trading goals. Now, remember that risk can never be eliminated in trading. Your goal is not to eliminate risk, but with knowledge, discipline, and effective risk management, you can navigate the Forex market with greater confidence and resilience. Okay, so this is it about risk management. I hope you've been able to pick a thing or two from this. When it comes to trading, you need to be able to have all of this in your arsenal for you to become the kind of professional and successful trader that you want to become. Hey, so that is it for today on risk management. See you next time. Stay stock in profit, and bye-bye. Cheers.